if you send an email to info@rightlinetrading.com. We're going to start today's presentation. Marc Sachs, who is with Right Line Trading. Short biography: Marc is a graduate of the University of Pennsylvania. He's a former professor at Jefferson College in Philadelphia, and he's been involved in the financial markets for over 20 years. Right Line Trading software is the product of over a decade of price action, market structure, and indicator algorithm analysis and optimization. You're about to discover how to get into the highest probability winning trades and stay out of the ones that just don't work. So without any further ado, here's Marc Sachs from Right Line Trading.
Hey, thanks, Rory. I really appreciate the introduction, and thanks everybody for coming in this afternoon and giving me your time. I'm not really going to go over my background because Rory pretty much covered that. All I wanted to say regarding my training is that it really focuses on mathematically modeling closed systems, and any trading instrument, whether it be stocks, futures, or Forex, are really just closed systems, and their future price movement is described by a series of independent variables. The key is to determine what those independent variables are. Once you do, they can be placed in a multivariable equation, and then they can be optimized so that you can really get a very accurate picture of how any financial instrument is going to move out into the future. Now, there's a big problem, I think, with current technical analysis, and probably to put it in a nutshell, it doesn't work. And the reason, that's the reason why 95% of day traders fail. And it's also the reason why that number does not improve year to year. We have one generation of day trader after the other who consistently maintain that 95% failure rate. Now, this is really unacceptable in any other endeavor. If we look at architecture, or we look at medicine, or we look at electrical engineering, no matter what field of human endeavor that we look at, a 95% failure rate would be absolutely intolerable. The biggest problem, again, and I really want to reiterate this, is that failure rate doesn't improve. And the problem is that each generation of day trader fails to learn from the previous generation. We take a priority that what we're taught from that previous generation is true, as if that previous generation was successful. So what it just causes is this cascade of losers who wind up getting busted out, but nothing ever changes. Are the current accepted trading dogma, which we again accept without any really specific mathematical verification, just continues, and we just continue to walk off the same cliff that traders have been jumping off of for the last 15 years. What we need to do is we need to question everything that we've been taught and look at the mathematical validity of everything that we've been told to trade, and the manner in which we've been told to trade. And if we do a Nexus Lexus search of the world literature to look at scientific investigations into the validity of technical analysis, looking at the precision with which it gets us into a trade, you'll find absolutely nothing. So essentially what we're doing is we are trading a methodology that's never been proven mathematically to work. And this is really the core problem and the reason why there's such an enormous failure rate. Now, I just want to give you a quick example of that. And it's very, very common to trade Renko bars with an oscillator. And it's a very, very naive combination, because what software developers don't look at is what the formula is for an oscillator. It doesn't make any difference what the oscillator is. It can be a stochastic, it can be relative strength, it can be the ADX ADR, it can be Williams K, but every single oscillator requires 4 parameters for each candle or each formation. And that is the open, high, low, close of that period. If you don't have those 4 parameters, you cannot trace out an accurate %K. Now, if you look at, in this particular case, I looked at range bars. Now, the instrument's unimportant. This could be stocks, it could be futures, it could be Forex. The particular trading instrument is really not critical in any way. That's actually irrelevant. But you can see if you trade range bars, you trade tick, if you trade time, you're going to get a high, a low, an open, and a close on every candle. And that's going to give you enough appropriate information to trace out this gold line, which is the %K line. And the green line is the signal line. Now, I'm not talking about whether or not an oscillator works or the stochastic works. I'm simply talking about here tracing out an appropriate %K, giving you the right overbought, right oversold signal. But if you look at Renko bars, there's only an open and a close. You're missing 2 of the 4 parameters you need to accurately create an appropriate %K line. So all that this oscillator is doing is simply tracing out price. And this is why so many day traders fail. And it doesn't make any difference, again, whether you're trading futures, Forex, or stocks. This leads to the downfall, because this crossover here means absolutely nothing. Now, I have a big problem with oscillators from my mathematical analysis of them. But you can see that there's a big problem just looking at this chart, because traders trade oscillators different ways. Now, there's a set of traders that look at a overbought signal on an oscillator as an opportunity to continue to buy all upside pivots as they're broken. In other words, they're saying that when the oscillator is overbought, the bulls are firmly in control of the market. And every time you get an upside pivot broken, you're going to continue to buy. Another set of traders look at exactly the opposite. They look to fade the market on oscillator divergence. And it can be MACD divergence as well. When price makes a higher high and the oscillator makes a lower high, they're going to look to go short. So you have half of traders looking for an overbought signal to continue to buy price higher and higher. The other half looking for divergence to fade the market. Now you'll notice, well, I'm just going to I'll point this out a little bit later. So that's the problem with an oscillator. Which way is the appropriate way to trade it? Do you fade it with divergence, or continue to buy an overbought, oversold signal as each short pivot is broken or each long pivot is broken? So what we did was we looked at 1 year of market replay data. It was actually 2 years, and looked at the precision with which an oscillator signal provides you in terms of getting a successful trade, getting to your first target. And both signals do not work. They don't have the positive predictive value necessary in order for you to trade profitably. So the oscillator on balance does not provide you with any accurate information to increase your trading precision. It doesn't make any difference whether you're trading stocks, futures, or Forex. Now, it's the same thing with Fibonacci. Fibonacci was a fairly esoteric mathematician who developed Fibonacci extents in the 18th century. Now, at the time that he created these, the stock market wasn't even around. And Fibonacci, for some reason, has has a lot of appeal. And I don't know what that appeal is, but a lot of people just gravitate towards Fibonacci and make it a real important core indicator in their trading. But if you look at Fibonacci extensions or Fibonacci retracements and look at the predictive value of an area holding or breaking, you'll find that they don't hold or break with any consistency, or the kind of consistency you need to use them as areas of support and resistance to trade off of. They're not going to improve your trading. They're only going to degrade your trading. And what we have to do is we have to discard a lot of what is considered to be core trading dogma that an enormous number of traders have already used and failed with, and look at something different to create profitability. So to sum that up, what is the predictive value of any indicator that assimilates data from your trading chart only? And the answer to that is essentially 0. And the predictive value of any indicator that works sometimes but not other times. Now, this is why 90% of day traders fail. If your indicator is using the data from your trading chart, it doesn't have any future predictive value. So let's just look at this slide for 1 second, because we're going to start from scratch, and we're going to start teaching you how to day trade or swing trade any market on any financial instrument. Now, the first thing that you have to do is you have to have a core methodology, and it's got to be based on math. It can't just be based on sort of seat of the pants what you feel is appropriate just because somebody else has told you. You have to look at the underlying math. Now, if you trade with a lot of sensitivity, now this goes to what your goal is when you trade. I mean, what is your objective? If you trade with a lot of sensitivity, you're looking to get in every true positive move. A true positive move is a win. So if you want to trade with a lot of sensitivity, you want to get into every trade that is successful. If you trade with a lot of specificity, you're looking to avoid the true negatives, i.e., you're looking to avoid every loser. So if you trade with a lot of sensitivity, you're looking to grab every winner. And if you're trading with specificity, you're looking to avoid every loser. If you trade with a lot of sensitivity, you're going to pull in a lot of losers. If you look to avoid a lot of, if you try to avoid all the losers, you're going to wind up not getting in every winner. But your overall core methodology has to be strongly tilted towards specificity. Your goal as a trader is not to get into every winner, but avoid almost every losing trade you can. That's really the goal, and I'm just going to show you that's the way the math works. Avoiding losers is the #1 goal of a profitable trader. You will get the winners, and you will be profitable. In fact, you'll be extremely profitable if you have the ability to avoid taking losers. Now, the positive predictive value of the number of trades that you get, the positive predictive value is an easy number. If you take 100 trades and 90 are winners, the positive predictive value of your trading methodology is 90%. If you get 80 out of 100 trades are winners, it's 80%. Now this is going to be reflective of the sensitivity over specificity times prevalence. Now prevalence is a very, very important mathematical value. We've already decided that between sensitivity and specificity, we're going to lean strongly towards specificity. We're going to look to avoid taking every loser we can. And we will get the winners. But we also have to trade only when the prevalence of getting a winner is high. And that is when there is a trend. And sometimes determining when a trend is present is just not as easy as it seems. And I'm going to show you how to define a trend, not just on your trading chart, but a multi-time frame trend that brings 3 time frames into alignment, that provides us with really, really low risk, high reward trading entries. So the prevalence of a winning trade increases in a trending market. And I always used to wonder to myself, how does the market go from chop to trend? Why does it chop? And really, the closed system, although it may seem esoteric, it's really not that esoteric. It obeys the laws of thermodynamics regarding a closed system. Every closed system, like any financial trading instrument, whether it be Netflix or Google or a small biotech or crude oil or the euro dollar, each financial instrument is a closed system, and it wants to move and chop. And what it takes in order to create order from this chaos is the application of institutional money. And I'm going to show you more about that in a second. And each closed system creates, each financial instrument creates a closed system that can be described by a series of independent variables. And when they're optimized, they can predict future price movement. In fact, they do it really well. Now, these are the independent variables that must be assessed on your trading chart in order for you to trade profitably. And I say must because you have to look at these independent variables. You have to do a multi-time frame analysis of trend. You must look at a multi-time frame analysis of correlative markets. And that is an indicator that assesses the flow of money across different asset classes. You know, all asset classes in the world are linked. And again, I'm going to show you more about that in a second. You must do a multi-time frame assessment of order flow. You must do a multi-time frame assessment of momentum. And you must leverage volume using market profile. These are the key metrics, the key independent variables on your trading chart that are required for you in order to become a profitable trader. If you look at these variables, an oscillator, a MACD, Fibonacci, classic Elliott wave, the reason they're called dependent variables is because they're moved by these. If you look at these, they move these. And if you try to trade with a dependent variable, all it's going to do is just confound your trading and degrade the predictive value of your entry. You're not going to trade with the precision that you need to trade with. Now first, let's look. Now this is our two-line indicator, and eventually I'm going to put this all together. But I want you to understand what we're doing. The top line is the multi-time frame assessment of momentum. And you're going to see it on the chart. Now, now it does not assess momentum from your trading chart. It assesses momentum from the 2 higher time frames. If you're trading a 3-minute, it's going to look at the 9-minute and the 27-minute. If you're trading the 377 tick, it's going to look at the 610 tick and the 387 tick, the 2 higher fib numbers. The same thing with range. It doesn't do any assessment or use any data from your trading chart. The bottom line is the multi-time frame assessment of order flow. And I'm going to go into more detail as to how we assess order flow. But order flow is based on the delta of each individual candle on the 2 higher time frames. And the delta tells us whether there's an overabundance of sellers or an overabundance of buyers sitting in the market looking to trade this financial instrument. Now, when the upper line is red, it means that both higher time frames have momentum aligned to the downside. When this bottom line is red, it means there's an overabundance of sellers sitting on in the markets on both higher time frames. So clearly this defines a clear-cut directional bias for you to trade. You're only going to take a trade to the short side, and it doesn't matter what you're trading. Now when the line is red, you're down on your 2 higher time frames. When the line is orange, you're only down on the highest term time frame. And the highest time frame always rules. When it's green, you're up on both higher time frames. When it's blue, you're up on the highest term time frame. But again, as always, the highest term time frame always rules. So let's take a look at some charts that show us how this works. Now, before I do that, what I wanted to do was just show you the delta. You know what, I'm going to skip this for now. Now, here is order flow. These 2 lines. The upper line is momentum. The bottom line is order flow. And you can see that when you have a multi-time frame alignment of momentum on your 2 higher time frames to the upside, price on your trading chart is going to go up. And remember, this is not looking at price on this chart. It's looking at the 2 higher time frames. When order flow is telling you that there's an overabundance of buyers on the 2 higher time frames, price is going to get pushed to the upside. Now, the way you know that these are both independent variables is that they're not looking at price on your chart. They're looking at only the 2 higher time frames. There's no assessment of market movement on your trading chart. Now, when order flow and momentum align, here momentum is aligned to the downside on both time frames. Here, order flow tells you there's an overabundance of sellers on both higher time frames. Here's where bias is short, and the only kind of trade you're going to take is a short trade. Here's another example. Now, this is the E-mini, but this could be crude oil. This could be any stock. It could be, again, it could be Netflix. It could be Google. It could be Amazon. It can be a Forex pair. It could be any futures instrument. When you've got an alignment on your 2 higher time frames of momentum to the downside, and your 2 higher time frames are telling you there's an overabundance of sellers, you can only trade to the short side. And if you trade against these 2 signals, the likelihood of getting a loser is exceedingly high. Now, you're going to look at these charts and you're going to see that there are traders on here trading oscillator divergence and MACD divergence. See this up candle? This is an overabundance of buyers in this candle. These traders are calling a bottom. They're saying that the market has gone down as far as it's going to go, and they're buying it up. But you can see they're trading against the multi-time frame assessment of order flow and momentum, and they get run over fast. This B candle is an up candle. We would trade the C candle to the downside. They get run over. Every up candle here, every green counter trend candle gets blown out of the market. You have to trade in the direction of the trend. The 50's down, and this is our modified 15 is red. And you have to trade in the direction of the multi-time frame of assessment of momentum and order flow. If you don't, the probability of getting a losing trade is exceedingly high. Now let's do a multi-time frame analysis of trend. Remember, this does not look at price on your trading chart. It's looking at price movement on your two higher time frames, so that price falling doesn't turn the background pink. The pink background tells you that price is likely to fall, and you are not going to trade the direction of the multi-time frame trend or your two higher time frames. So what that pink background is telling you is that on your two higher time frames, which in this case are your 8 range and your 13 range chart, the 50 is down, the 15 is down, and the shorter term time frame, or the 15, is crossed the 50 to the downside, and support to the downside is broken. So when you have a pink background, you have a free and clear trade to go short. All you need is an entry. So the important thing here, this is not giving you an entry. Just like order flow and momentum, it's giving you a directional bias. It's telling you the only way to get a low risk, high reward trade is to take the financial instrument you're trading to the short side or down. And again, you see all the traders calling bottoms with these green candles. They've decided the market has fallen as far as it's going to fall. They're trying to counter trend trade. They're using oscillator divergence, MACD divergence. They're trading off fib support. It doesn't work. They're going to get beaten up and crushed, and they get run right over, because you only get a multi-time frame alignment of trend during an institutional move. Only institutions can apply enough money to create a 3 time frame trend alignment, your trading chart and your 2 higher time frames. Now, you can do it without this indicator, but it's a lot of work to look at an 8 range and a 13 range. Look at the color of the 50 and the 15 period moving average. Make sure that the 15s cross the 50 to the downside on both your 2 higher time frames, and check support and make sure all of that is broken. You don't have to do any of that. All you have to do is wait for this pink background, and it calls you a short trade. It calls you a trade that gives you a strong directional bias. And here's a long trade, just the opposite. Here the 15s cross the 50 to the upside. The 50 and the 15 are green. All resistance to the upside is broken. You look for a pullback. This is a 14.25 point move on the E-mini. This is 11.75 point move on the E-mini, and this is in the same trading day, simply by trading in the direction of the 2 higher time frames. And in every single trade, you see traders trying to counter trend trade. They're in those red candles, and you can be guaranteed that they're going to get run over. They're trading against the direction of the 2 higher time frames, and they're trading against the direction of institutional money, and they're going to get beaten up bad. Now let's look at correlative markets. This is another independent variable that you must assess to make the entries you take as precise as possible. I'm sorry here. Let me just take care of this really quickly. The only time this ever happens to me is when I'm giving a webinar. Okay. Now, we know that on every financial instrument, so let's say you're trading the E-mini S&P. When the E-mini falls, The NASDAQ falls also 70% of the time or greater. Now, these are called correlative markets. The E-mini and the NASDAQ correlate in direction. Now, when the E-mini falls, bonds and notes go up. They're inversely correlative. And all this is the rotation of money by institutions across asset class. Now, I didn't show you our correlative markets for stocks, but they are awesome. If you trade stocks, our correlative markets are absolutely outstanding. I'm going to show you how they work, but they are really powerful. And what we're doing is we're looking at the rotation of money across sectors by the institutions, by looking at markets that correlate with the direction of the financial instrument you're trading, and markets that inversely correlate. Now, this is Treasury notes, and remember, these are not only not looking at price on bonds. They're not even looking at bonds. These are looking at other correlative markets, and there are 3 markets in each line, 6 markets. Now, the reason we call these quant lines is because if the market correlates really tightly, it's quantitatively weighted much more tightly in the line. Now, green means, dual greens, mean that 6 markets are moving in the appropriate direction to tell you that the institutions are rotating money across asset class, and they're rotating money into bonds. And you can see when you have dual greens here, the bond market goes up. Dual greens, bonds goes up. And bonds, this trading chart on bonds, this indicator is not even looking at bonds. It's looking at other markets. In the last case, we're looking at indicators that look at other time frames. Now we're looking at indicators that look at other markets. And look what happens when there's no sector rotation of money by the large institutions, and the quant lines are yellow. Bonds just breaks down into total chop. This is when the prevalence of getting a really successful trade is low, and you don't want to trade. Here's another example. This is the E-mini S&P. Here we have 9 correlative markets. Green, 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 you're going to trade long. Green, 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 you're going to trade long. This tells you the flow of institutional money across asset classes is moving into the E-mini and its correlative markets, out of those financial instruments that inversely correlate with the ES. Very strong directional bias. So now we've looked at multiple independent variables that give you a strong direction to trade. You're going to see when we put those all together, you're going to see how powerful a direction you've got and how you're not going to want to trade in any other direction except the one that's pointed out to you by the software. Now let's look at market profile. Now, market profile is extremely critical. It is the premier way to leverage volume because it's really based on very, very sound math. Now, in a perfect world, volume across any financial instrument at any given period would be normally distributed. And any normally distributed data creates a bell-shaped curve. And this is the mean, this line in the middle, and one standard deviation of data, in this case, I can't pronounce it, but one standard deviation of volume above and below this mean creates what's called the value area. For trading, that's fair value of the financial instrument. Now, here's our market profile. It's an extremely powerful market profile and different than most others. Now, between the value area high, which is magenta, and the value area low, you have fair value for the financial instrument. Now, this is where 66 2/3% of all volume at price has crossed. And traders want to keep price within fair value. That's simply a mathematical axiom. So the value area high is going to repel price to the downside. The value area low is going to repel price to the upside. And the point of control, which is the price at which most volume is crossed, is going to attract price. So you have a lot of forces coming to bear on your financial instrument because of the fact that you're trading in an auction style. Everyone's buying and selling, buying and selling. They've created this fair value price for the financial instrument, the price that most people want to trade the financial instrument, and that's where price wants to stay. Now, there's a little bit more to it than that. There are also critical low volume nodes. Now, these low volume nodes must be assessed because they're the opposite of the point of control. The point of control is where most volume is crossed. These low volume nodes are where almost no volume is crossed. Traders don't want to trade at a low volume node. So the low volume nodes also repel price. So here's what you ultimately wind up with. Zones of rejection. And today, when we in trading the E-mini, these zones just saved us from taking multiple losers. Price would not break them. They consist of the low volume node that repels price because price does not want to trade at it, and the value area high, which repels price because price wants to stay in fair value. Two separate forces coming to bear on your financial instrument to keep it within this area, pushing it out of this zone. Same thing with this zone here. This is a zone of support depending on where price is. You have the low volume node repelling price and the value area low repelling price. So these areas, now I've seen a lot of charts that use market profile make a lot of fundamental mistakes. They'll characterize these zones as support or resistance, and they're not. They're simply zones of rejection. They are prices where our financial instrument does not want to go. If they're broken, if this upside resistance is broken, it then becomes support. If this downside support is broken, it then becomes resistance. So it can't be characterized as support or resistance. The other critical thing is that every time a share or a lot or a contract crosses, volume profile changes. And therefore, market profile must change intra-candle. I have not seen a single market profile indicator, and I'm not saying there aren't. I'm just saying I haven't seen one. I have not seen one make an assessment intra-candle, and ours does. Ours recontours these zones intra-candle so that you're on the right edge. You always know exactly where your upside resistance is and your downside support. Plus, if we go back a slide, this volume profile cannot just assess volume from your trading chart. It's got to look back a couple of days to give you a more stable market profile. Here's another example. Trading up into resistance. It hits, it bounces, it comes down to support, it finally breaks it, but then it comes back. Support acts as resistance, and then we trade to the downside. Now I'm going to show you some system-generated entries. Now here is what's called a strategy entry. Now a strategy entry is a system generated or a software generated signal to get you into a really, really excellent trade. Now remember what I said, that it's impossible for software or for a signal that looks simply at price on your trading chart to generate a good entry, or even to create a good signal. This strategy entry is a multi-time frame assessment looking at market structure on multiple trading charts. And when it hits, it's a really great entry to take. And you can see it hits intra-candle here, plenty of time to take it short. Your short would be at the close of the candle, one tick below the close and down. And here is a long. Now you see that the 50 has to be green, the 15 has to be green, the 15 has to be red, the 50 has to be green or rolling to yellow in order for this to signal. And there's got to be a multi-time frame alignment of price action, market structure, and trend in order to get this signal. It just doesn't take a signal off your trading chart. And it gives you very, very system-generated, precise entries. And here's our ABC entry. Now the ABC, anytime you get two candles of the same color in contiguity, that defines a downtrend based on price action alone. So the software will put an A here because two reds or two oranges in a row define this A downtrend. Then you get a third, then you get a fourth. Now what we're doing is we're looking for those buyers, those unfortunate buyers in the counter trend candle, and they're always going to come. These are traders that have decided that the market's at a bottom. They're going to counter trend trade. They're looking at oscillators, they're looking at fibs, they're looking at Elliott wave. They're looking at something to tell them that they want to go long. Now I simply decide that I want that B to be magenta. You can make it any color you want. At the close of the B, you get an audible alert to tell you that there's a potential engulfing C to the downside, because that's what we want to take. We want to take the continuation trade in the direction of the trend and overrun these counter trend buyers. So the trade is going to continue with two forces. One, that's going to continue with the addition of new sellers, because this is an institutional move, because we have a multi-time frame alignment to the downside. And it's also going to continue down because we're going to stop out all the traders in this B candle. And when they're stopped out long, they've got to sell their contracts to get out of them, and they're going to push this move down. Here's the same thing again. Unfortunates in the counter trend direction, trying to buy the market to the long side in a clear-cut downtrend, using the signals I mentioned: oscillator divergence, MACD divergence, Fibonacci support. Well, it's not going to work, because the market is going to head down in the direction of the trend almost always, and it's going to, the C engulfer, you're going to get the audible alert on the B, the C is going to flash, you're going to put your sell stop one tick below the close of the C, you're going to be in short, and you're going to ride it down in the direction of the trend. Here's another trade. C candle, continuation. C candle, continuation. 50, 15 red, 50, 15 green. You get the C up and the C down. And these were trades that were taken live. Now there's a third system generated entry called the consolidation entry. And this is a great entry, because what it is it's our software reading market structure for you. Now what a lot of people don't want to trade consolidation, because it's a period of time where market volatility drops. And again, I'm looking at futures, but it can be any financial instrument. It can be stocks and it can be Forex. Now the system is going to generate an intra-candle triangle. And that is a system-generated signal to tell you that this is going to break out of consolidation in the direction of the trend. Either triangle would have given you a really nice winner long. Now what happens during consolidation? What happens is volatility drops because sellers, the power of the sellers and the power of the buyers becomes equal. You've got a long candle here, predominance of buyers. You have a doji here, predominance of sellers, predominance of buyers, predominance of sellers. Volatility drops. You see the software creating this channel. It's blue up, green down, red down line, and then the software system generated break to the upside out of consolidation. This is a great signal. Here's another one. Now, sometimes it's hard to read price action. Now, this is a smart indicator. Consolidation is here, but you don't get a signal. It analyzes the 15, the 50, and will only give you a software system generated entry when it's tradable. And it's going to come intra-candle, and you're going to take it long, one tick above the close to the upside. Here's the same thing again. 40 to the upside, 10 to the downside. It's a very low risk, high reward entry. Always in the direction of the multi-time frame trend, and you're going to see how all the indicators come together. Now, here are all of the indicators. Here are the correlative markets. On crude, there's only 3, so there's 1 quant line. Here's the multi-time frame assessment of momentum. The bottom line is the multi-time frame assessment of order flow. These were 2 trades taken live on 4/21. This was a down trade. This was a pull-up, green candle here. Counter trend traders overrun to the downside on crude for 19 ticks. Traded pink background bias tells you that the market's aligned to the downside are your 2 higher time frames. Correlative markets telling you money is flowing out of crude oil. Multi-time frame momentum is to the downside. Order flow tells you there's an overabundance of sellers. You're down for 19. Comes back to resistance. Take it right back down again for 44 ticks. You've got the direction. You just need an entry. Everything is telling you the way to trade is to the short side. Once you get a pullback to resistance, you're going short. Once you get a pullback or retracement candle, you're going to overrun that trader, these groups of traders, and go short. Now this is one this is one from 6/17. I'm sorry, it's from 4/28. I think it was last week. Again, a little more complex setups because the background bias has 3 different down colors, but red, 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 red all the way down, we got a point. Here, red, 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 red all the way down, we got 2.5 points. This was a lot riskier a trade. It only went 5, but I traded in the direction of multi-time frame order flow and multi-time frame momentum. It took the trade down 1.25 points. 3 trades, and that was it for the day. We had 3 winners who were done for the day at 10:30 a.m. Eastern time. You can see the time right down here. The last trade we took was at 10:20, and we're finished. Here's another trade in the direction of the 3 correlative markets. I don't have order flow and momentum here. Background bias is long, 3.75 points. Here's a beautiful short trade on the E-mini for 4.75 points. 19 ticks on the E-mini. Red, red, red. Leveraging this pullback, these traders trading standard methodology, divergence, fibs, whatever, they're trading a counter trend candle, guaranteed to get run over. And here it is again. The counter trend candle short, overrunning them to the upside for 3 3/4 points. This is a transition zone trade, but here's the entry. That's 34 ticks in the direction of the multi-time frame trend. 50 down, 15 down. Here's your quant line telling you that money is flowing out of crude. Here's another entry, 34 ticks, pull back to resistance off of this retracement candle. Traders going long against money flow, against the multi-time frame alignment of trend, and they're going to get run over as they always do. And even in this area right here, where you have an area of consolidation, consolidation almost always breaks out in the direction of the trend. All these counter trend traders in these green candles all get run over when crude continues lower. So what's our goal is to combine all of the independent variables that we believe predict future price movement into a simple platform that's, I left out the T here, I'm sorry, that's been optimized mathematically to provide you with really accurate trading entries. And the reason they're so accurate is you've got such a strong directional bias. You're looking for the pullback, and you're looking for the continuation trade in direction of money flow, leveraging market profile, order flow, and momentum, as well as correlative markets. Now, I didn't have an opportunity to show the correlative markets for stocks, but they are really great. Now, we also have our own trade execution platform, which comes with the software. And we don't ever take a trade intra-candle. I believe that if you trade intra-candle, I mean, the market is expressing itself in each candle. And it's telling you about the power of the buyers, the power of the sellers, the size of the wick is giving you information. You want to buy at the close of a candle. But this allows you to do anything you like. Now, if you're trading time or you're trading a tick chart, and you can, those are I like to trade range, but time and tick work real well. And you just want to buy on the close of a candle to the upside, but you don't know where it's going to close because you're trading, you have to wait till the time expires or ticks run down. You simply press buy an up close or sell a down close. This will get you in one tick below the close or one tick above the close very precisely. It's going to do it much faster than you can do it by chasing it on your dome. And then it gets you out of a loser earlier by getting you out on a reversal candle. I don't want to get into too much detail, but it also gets you out of trades with less of a loss when you do take losers, and occasionally you will. Now, it's patent pending. It's in front. A lot of people say they have a patent pending piece of software, and they don't, but we do. It's in the patent office. We have a patent serial number. It's been there for 2.5 years, and we're still waiting for a patent approval. They're so backed up on software, and this has really thousands of lines of code because it's a trade execution platform. So here's our offer. Now, you get the trade execution platform forever. It's a permanent license, and that's a $1,500 value. And I'm telling you, no matter what you do, it's going to help you trade better. It's going to get you into the trades with incredible precision, and it's going to get you out of losers with less of a loss. You also go into our live trading room for 3 months, and you're going to trade with me. I have not taken a loser yet this week. You're also going to come into our trading school. Now, we're starting our 10-week, it's called our Back to Basics class next Tuesday. Actually, a week from tomorrow. A week from tomorrow, on the 10th of May, I believe it is. And that's going to teach you a soup to nuts approach to day trading or swing trading. It's really going to teach you the right way to trade. We've graduated hundreds of professional, profitable traders from here. You also are going to get access to our video library. We have 450 videos, which are on closed link to allow you to really study our trading methodology. We're going to give you chart templates for over a dozen different markets. Now, we have a lot of standard templates we'll give you, but let's say you want to trade a unique stock on a unique time frame. Let's say you want to trade daily bars, or you want to swing trade on 4-hour bars. We'll teach you how to make a template, but we'll also provide you the template. It's a lot of work, but we save you that work. Now this is really really the most unique part of the offer. We're offering the full indicator sweep, which is $27.50. But for the first 5 people who purchase, we're going to give you the automated system as well. I showed you the signals that the software generates. I think it's the best automated system that there is. So you're going to get the discretionary system and the automated system. Now the total value is higher than this. I just didn't recalculate it. It's about $12,000, and it's only for the first 5 where you get both the automated and the non-automated. And you can get it for $27.50 one payment, or $1,500 2 payments 30 days apart. Now the overall offer expires on 5/16/17. The first 5 will get both the automated and the non-automated. And what I want to show you real quickly, now that's awesome. I want to have time to answer questions, and I'm moving in on 2 minutes. RightLineTrading.com, info@rightlinetrading.com. Our phone number is 855-765-6681. And what I want to do real quickly here, if I can find it, is show you our performance. We have it posted, both for our room and for the automated. And then I'll see if I can answer as many questions as I can. Now this is the automated system. I shouldn't have brought up the Internet Explorer, but it's the only one. It's loading. Here it is. Now this is our trading room. We made $2,944 on 2 contracts in April. We have 2 successful trading days in May. And here's our algorithmic. Hold on a second. I got to get down all the way here. It's up $4,323.33 through the 17th, through May of 2017. Now, this is on a very small trading account. We're approaching a 100%. So I just wanted you to show our performance. We track every single day, every trade, every day. So let me see if there are any questions. Let me just take this out. Let me move the slides back real quickly and just move down to our phone number, and let me see if there are any questions. It's a new way of trading. It's looking at higher time frames. It's looking at correlative markets, and it's getting you in and with very, very precise entries. Okay. There's a bunch of questions. Let me try to get to all of them before we run out of time. The charts I have on those, okay. Marcel, we definitely care about news. And what we do about news is we usually stand aside for a short period of time. We let the market calibrate. We let it settle down. We look for the multi-time frame trend that the news creates, and then we're in. Now, is BB any good? You have to tell me what BB stands for. I just don't know what that is. I'm sorry. You know what, dude, I would, except right now the market is dead. If you want me to show it, I will. Hang on a second. I just don't know if I have the time, but I'll bring it up while I answer questions. Okay? It's coming up. I'll see if I have time. But I'm loading the system right now. And let me just go back to our, so the system is loading. All right, hang on one second. Let me just see if there are any others. Here we go. Kathy, we have one system that's manual and one that's automated. To the first 5, we're giving both. So you can, now the automated system trades gold, the NASDAQ, it trades the 6E, it trades bonds, it trades notes, it trades crude oil, it trades multiple instruments. We trade the discretionary in the room on crude oil and the E-mini. Today there was a really nice winner on the automated on gold, and I'll show it to you if we get the system up. Yes, you'll get a recording. It's real good for Forex. I traded the Forex for months on the system. You get the same identical signals. Now, I'm just 3 minutes over. No, it won't, Robert. It's only active right now on NinjaTrader. It'll be active on Sierra very shortly. It doesn't work on Thinkorswim. I'm sorry. You can take the signals. I use Thinkorswim, but I take the signals off of Ninja. It doesn't work with multi-charts. I'm sorry. It works on Ninja. The learning curve, Thomas, is very, very short. I'm not a fan of Bollinger Bands. I just want you to know. It doesn't work on trade. We're going to have it on TradeStation soon. We use the 15 in this. We use the 15 and the 50 just because I just think those time frames work really well. And they're both proprietary moving out. I'm just going to show you the system really quickly. Then I have to step aside. If you have any other questions, you're more than welcome to give us a call. Just let the system load. This week, we're finishing. It works great on Spot Forex, but you can't trade the Forex on MT4 because right now we're going to be on MT4 eventually. We're only on Ninja, and we're going to be on Sierra. And eventually, okay, here comes the system up right now. Now, here's my playing around. There was nothing to trade on the E-mini today. Nothing. It was just all chop. It was a mess. And this is my teaching in the room this morning. Yesterday, these were our 3 winners. We had 5 ticks, 3 ticks, and 8 ticks. Today, now see here, we closed the room and then crude collapsed. We got 8 ticks, we made $80, and if we would have stayed, here was our system generated signal, right here. A perfect entry. And here's another perfect entry. But there was no way to know. I mean, we were long since closed out of the room. We closed the room at 11:30, 11:56. We got this entry, and we got this entry. And these would have been very big winners. There's no way to know that. This would have been, I mean, maximum excursion, 18 ticks. Maximum excursion here from entry to minimum, 26 ticks. And you see on both entries, system generated signals, quant line red, multi-time frame momentum red, order flow red, entry perfect. Here, same thing. Out of consolidation, system generated. Quant line red, so your correlative markets are telling you that money's coming out of crude. Multi-time frame momentum, multi-time frame order flow, and down you go. And the market still went down, but now it's oversold. We can't chase it lower. But we had two huge trades. Yes, Bruce. Just give us a call. Just send us an email. Yep, that's it, right here. We would have caught it and gotten in on a great trade. Two of them, right here. Now, we define oversold when the space between the 15 and the 50 exceeds 18 ticks. It's now 40. We can't trade it shorter anymore. Can't get it lower. But these are both $300 or $400 trades. And see, for the day, we made $230. Trading very small numbers of contracts. And this is live on the right edge. So listen, everyone, I hope, yes, Bruce. So I hope everybody got a lot out of it. Again, here's where we are. www.rightlinetrading.com, info@rightlinetrading.com. And I'll just say this to close, and then I'm going to turn it over. If you wait for these things to align, you're going to get great entries, because we're not doing any assessment of anything on our trading chart. These lines are assessing multi-time frame momentum from the higher time frames, multi-time frame order flow from other time frames. These are looking right here at 9 correlative markets that are not the E-mini. And when they align is when you get your great trades. So you can see how choppy they are here. There's nothing to trade. The E-mini was a disaster today. All we did today was use the software to avoid losers. And we still took $230 out of the market on only trading 2 contracts. If you traded 4, you made $460. So listen, everyone, I'm going to turn it over. Have a great afternoon. I hope you'll come aboard. You're going to make money, because we make money in the room.